Is this a make or break moment for the markets? Well, today we're going to talk about market valuations. We're going to talk about margin debt. We're going to talk about price momentum. And we're going to talk about market participation. These are all factors that we need to know to decide what's next for the markets. Near the end of the video, I'm going to present a very, very important volatility signal that you need to pay attention to. And then I'm going to give you 4 specific solutions to be able to trade in the right direction depending on what happens next on the markets. And at the very end of the video, I've got a special bonus for those of you who are passive investors. You guys know I can be a bit of a trader, but I'm going to offer a solution for passive investors in the very best way you can construct a buy and hold portfolio in the current environment. My name is Keith Richards. I'm President and Chief Portfolio Manager of ValueTrend Wealth Management. And this is the Smart Money Dumb Money Show. And because you're watching, you're smart money. Okay, before we get into our factors looking at today's markets, I just want to point out, I did a video recently called Crash and Burn Victims. At the end of the video, I asked viewers to list some of the depressed stocks that they perceive as value. And honestly, it's worth going back to that video just to look in the comments because there were some really good ideas presented by you, the good viewership, on value ideas of depressed stocks. So do take a look at the video and do take a look at the ideas that many of you commented on. And again, I do read your comments, so please feel free to comment at the end of this video. Anyways, we're going to start off with the price to earnings ratio. Now, there's many different ways of looking at the price to earnings ratio. There's trailing price to earning ratio, which is the looking at earnings that have historically already been booked. There's forward price to earnings ratio, which is an estimation by the street on what the earnings will be versus the current price. And then there's the cyclically adjusted price to earnings ratio, which is the inflation adjusted price to earning ratios created by Dr. Shiller himself. So what I want to look at today is the trailing PE. Why? Because I only look at reality. I think forward earnings is more of an estimation and I'd rather look at reality. And the next thing we're going to look at is the inflation adjusted of that trailing PE. So we're going to start with the trailing PE ratio on the S&P 500 right now. And I've talked about this in the past, but just one of the things I wanted you to note is going back to the late 1800s and right into around 2000 or so, the modern era, a low PE ratio was considered around 10. And same thing around that era, a high PE ratio was considered around 20. So when the markets got around 20, it was expensive. When the markets got around 10 or lower, it was considered cheap to buy. Things changed as the technology boom took off right around the late 90s into the 2000s. And currently the roles have changed. So right now, the lows of PE ratios are around 20 and the highs are around 30. And you can kind of see that when PE ratios went very low after the '08 crash, that was a good opportunity for buyers. When PE ratios went over 30, as they have a few times since 2000, then it was considered a expensive market. So where are we right now? Well, if I back this indicator up a little bit just so you can see, we're at around 30. So we're right on the cusp of being, quote unquote, an expensive market, at least by this metric. It's something we should keep in mind insofar as how much more does this market have to go. So the next thing I want you to look at is the cyclically adjusted PE, Robert Shiller's famous PE. And basically it just takes inflation into account when we look at those earnings. And what we're seeing here is that the cyclically adjusted PE ratio is 39.6, which is the second highest it's ever been since 1890. So it's expensive even according to inflation adjusted earnings. So something we should keep in mind. This market is definitely not cheap by fundamental classic metrics. The next thing I want to talk about is margin. And margin is something that investors use to leverage their investments. They borrow against their current portfolio so they can buy more of the stocks they want. Well, margin is a useful tool except for when the investment market is getting overly enthusiastic or too confident or complacent about risk. And that seems to be what's happening right now. Take a look at the angle of ascent in margining and take a look at the fact that margin is at record highs. In fact, it's exceeded even the 2008 peak bubble of probably the worst crash that we've seen since 1929. The amount of margin on the markets right now is exceedingly high, and it's really ramped up through 2025 as the whole AI thing took off. I'm very concerned about this. This should be a sign to you guys that the market is overconfident, and that's never a good thing. Next thing, momentum divergence. And what I'm going to point out here is the basics of the current uptrend is good, but you'll notice how tight that trend has been. We are above the 50-day moving average right now. We are above the 200. So trend following rules suggest the market's okay, but we're seeing signs of momentum falling. This is money flow momentum. In other words, money that's going into or out of the market, and the positive money flow momentum is slowing, as you can see here. You can also see on the MACD histogram that it's starting to form a bit of a top, but more importantly, the histogram right here is showing that momentum of price is slowing. That's usually a heads up for some sort of a correction. Now I've got two indicators that illustrate market breadth, and that is the participation by all stocks on the market. If the S&P 500 has 500 stocks in it, then we want to see the majority of those stocks going up in an up market. That makes sense, right? A healthy market is a broad spectrum market. But what we're seeing here on this indicator is market breadth is trending down. This is the percentage stocks that right now are trading over their 50-day moving averages. And you can see really since around the middle of the year, the trend has been down. And yet the market has continued trending up. That tells us that only a few stocks are doing all the lifting, and most stocks, in fact, 60% of stocks, are below their 50-day moving averages right now. And that's not a good thing. Another interesting phenomena is the new high, new low indicator on the New York Stock Exchange. So this is the entire New York Stock Exchange and how many stocks are making new highs versus new lows. Well, wouldn't you think if the market's going up and is in a strong trend, you would have all kinds of new highs compared to the number of new lows? Not really. It's only about 60%, 66% as I speak, are making new highs. So that means that we have, 34% or something close to that of stocks that are not even making new highs in this very strong uptrend. So again, a sign of kind of a wishy-washy market. So I mentioned at the beginning of the video that we want to pay attention to this very important volatility indicator, and that's the VIX. Some of you guys have heard of the VIX, the volatility index. It just measures premiums on options. But what I want to show you here is we're going back to 2020 here, and the general trend is if the market is going up, then typically volatility is falling. That makes sense. People are getting more and more confident. Well, when markets are going down, typically the trend for volatility is to go up. And you can see that relationship here over and over. And this is I just did a 5-year chart or something here. Well, you can go way back in history and see this illustrated. Market was going up between 23 and the end of 24. Volatility was falling over and over. So when the market fell in around the April Trump announcement of the tariffs, well, volatility went up. In fact, it went quite high. Well, this is what's interesting right now is that volatility was falling as the market was rising, but recently volatility has been picking up. You can see that here. If I zoom in, I want you to take a look. Volatility literally since about April is going up at the same time that the market is going up. That's not a historic relationship that I have seen, well, really many times, if at all, in my career, and I've been doing this for 36 years. So this is something we should keep an eye on, because eventually, if the trend returns to the normal situation, which is when volatility is climbing, the market goes down, then we ought to be very, very careful. So I promised you at the beginning of the video, I would give you 4 solutions to this somewhat tepid market environment. It's not an outright bearish environment, but there are some signs that we just looked at that we need to keep our eyes on. So what I'm going to suggest is we watch for a breakdown. I'll explain every one of these in a minute. We hold only the stocks that are worthy of holding and get rid of the stocks that are the most dangerous positions. And at the end, I'm going to talk about the best way for passive investors to invest. So let's talk about rule number 1, which is watch for a breakdown. This is the 50-day moving average, this blue line. This is the 200, the red line. Well, so long as the market is holding above the 50-day moving average, it should be healthy. Typically, this moving average will maintain an uptrend, which it has since the April pullback over the tariff announcements. Well, if that continues to hold to support the market, it's in good shape. You will sometimes see a spike below the 50, but generally speaking, we want to see a prolonged adherence to that moving average. If we do, we don't have much to worry about because the trend is still our friend. The next thing is, if you are in fact concerned about some of the factors that I just mentioned, you can do some of the things that Craig and I are doing at ValueTrend, and one of them is reduce your technology exposure. The tech stocks are showing signs of weakening. This is a chart that I printed up this week, and you can see that Nvidia pulled back, Microsoft even, which is probably one of the better long-term stories out there, has pulled back a lot. Meta literally broke support. It's in really rough shape. And we're seeing even Tesla consolidate within that prior uptrend. So these are factors to keep in mind that the former leaders, which is the tech stocks, are starting to show some early signs of weakness. So what we are doing is we are focusing on things like commodities. For example, the base metals, natural gas. You guys have heard me talk about these before. We own some of the precious metals like platinum and palladium. We, in fact, own this specific ETF, PPLT, and gold, of course, which I've owned for 2 years now and was a fairly early adapter to that trade. And we also own silver. So these are commodities that we like, and I would encourage you to consider holding in your portfolio. Now, the final thing I want to talk about is cap-weighted versus equal-weighted ETFs. So many of you watching this show may be what's called passive investors. You just like to buy something and hold for the long term. And there's nothing wrong with that because, of course, over time, markets go up. The problem being right now is that if you look at the cap-weighted S&P 500, which is the standard S&P 500 index that we all follow, it's very overweight in about 7 or 8 stocks. And those overweight stocks are the ones I just showed you, like Meta and whatnot. They're starting to show weakness. So we can instead hold a equal weight ETF, and they will hold the full 500 stocks in, like the word explains, equal weight. It doesn't have the same pattern right now as the S&P. That's because the S&P 500 cap weighted has been led by these tech stocks. But my feelings are that you're going to see, as the tech stocks continue to weaken, that the other components of the S&P will, on a relative basis, outperform. So at ValueTrend, we own this particular ETF. There's tons of them out there. We are bulls on foreign currencies outside of Canada. So we're kind of bearish on the loonie. We explain that a lot in our blogs. But we decided to buy the Invesco S&P 500 equal weight. I'm not endorsing it specifically to you, but we wanted to own the US dollar version. You can also buy hedged versions of equal weight ETFs. You know, you can do your research. The point is that I think that for passive investors, right now it may be the better move to own an equal weight ETF than it is to buy a cap weighted ETF because of that overvaluation in the very small group of stocks that may just end up hurting the overall markets as they round over. All right, well, thanks for watching, and we will catch you next week with more great ideas. Don't forget, like and subscribe, and remember, you can comment and I'll read your comments, and be sure to share your ideas with the community. That's what this is all about. I don't know everything. I think you guys, as illustrated in my last video, can come up with some great ideas to share with the community, and I encourage you to do so. See you next week. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at ValueTrend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.